I'll take it. Good morning. My name is Brian Conlon. I'm with Meridian Pacific Properties. I'm in charge of business development, and we're having our third COVID Meridian update today. So on the phone webinar today, we have Jordan Varvel, who's our business relationship manager or client relationship manager. We have Ken Coykendall, who's the president of Meridian Pacific Properties, and we have my father and principal and co-founder, Kevin Conlon. Today, we're going to be continuing the update about how the real estate market is performing nationally and also locally in the Memphis market in the midst of the COVID pandemic. So I want to thank everyone again for being here. It is our honor to share a little bit more about what we're studying, what we're seeing, and what we're experiencing out there, because we really want to educate our investors and share with you all what we're seeing ourselves. So we're going to go around the horn here and talk about property management, the local market, et cetera, here in just a moment. But kind of a logistics point that I want to make to all the folks that are out there watching. There's a Q&A button at the bottom of the Zoom box. And if you use that, you can type in a question that we will be able to respond to at any point. So if you do have a question that pops up, please type it in the text box. When we get through our presentation, which will be about 15 or 20 minutes, Jordan will walk us through the questions, then we'll have a chance to answer them at that time. Let's see. With that being said, I think that covers all the logistics for today. So I'm going to go ahead and turn it over to Kent Coykendall and get an update on the local market out there in Memphis.
Great, thanks, Brian. And it's a pleasure to join everybody here this morning. We want to give everyone a quick update on the Memphis environment in general, and then about our properties in Memphis. And this has been a tumultuous week here across the country. And Memphis is one of the hot spots in the civil rights, historical origins of the civil rights movement. So it's very pleasing to report that the activity here has been very limited and very peaceful. There have been very little violent events. There's been a curfew downtown. There's been a curfew imposed in a few high-profile retail areas, but there's been very, very little violence and very little protests that have gotten out of control. So that's the good news. Therefore, there's been no real effect on the safety in the community or on the economy. So that's great news compared to what we're seeing around the country. In terms of unemployment, it's worth giving just a quick update. We said all along that Memphis's economy, based in distribution in logistics, probably has not been affected as much as some other economies. And the April figures came out this week nationally. And Memphis's unemployment rate is around 12.5%, which is about 2% below the national average and about 3% below the regional average, such as Nashville, which is 2 hours away. They're about 3% higher in unemployment due to much more of an entertainment and hospitality economy. So as we have been saying, for the most part, Memphis is much more of a distribution logistics economy, and those businesses are booming. Folks like FedEx are hiring. Warehouses continue to be built in unprecedented levels. So the construction industry is going strong. The housing construction industry is going strong. And that was always considered essential businesses. So it's good to report. It feels good to report that the economy continues to be consistent. And then when we look at our own tenants in our Class A properties, that's even as best we can figure, and these are hard numbers to come by reliably. We've probably got less than a 5% unemployment rate, and a lot of our tenants have dual incomes, so they've got a little diversity there. But we have not encountered much unemployment with our tenants at all. And in the total environment in Memphis now, courts are now reopened, and eviction moratoriums are coming to an end. So the normal practice of landlord-tenant relationships is slowly getting back to normal, which will continue to ease any pressure on delinquencies and any other aspects of the market, negative aspects of the market. But in terms of rent collection specifically, given our strong 99% rent collections in our single-family homes the last 2 months, This month going into June, we actually didn't even feel the need to continue the extra communications that we have with our tenants, talking about possible rent deferral applications and things like that. We just haven't seen the need. So that's very good news. And as of June 3rd, which was yesterday, we've collected 62% of our rents for the month already. That's well above our monthly average of about 40 to 50% of rents collected by this month. A little bit of that is calendarization. Monday, Tuesday, Wednesday were the first, second, and third of the month, so the rate of collections was up a little bit. But again, low unemployment rate, higher class properties, the economy is reopening, people getting back to work. You know, a seminal part of, even though it's not a big part of the economy here, Graceland reopened about 3 weeks ago. So, you know, that just sends a signal. And again, we always do a very good job screening our tenants for the type of incomes and the type of jobs and the type of credit scores that will lead to strong performance. So bottom line is rent collections have maintained above 99%, and we're expecting that in.
Well, looks like we may have a dramatic pause here. But yeah, rent collections have been good. Until Kent gets back, Dad, why don't we move it over to you and have you talk a little bit about what we're seeing kind of in the national and also regional market, just with single family residential in general.
Oh, well, sure. Just to
Stable. Can you guys hear me okay?
Oh, yeah. Yeah, you're back.
Well, can you guys hear me okay?
We sometimes would be the short answer. Can you hear us, Kent?
Okay, sorry. We've got a thunderstorm coming through right now, and that tends to affect I'm in Memphis this week. I get out here about once a month, and we've got an aggressive thunderstorm going right now. So I will continue until you ask me not to continue if you can't hear me.
Okay.
Our leasing activity is as busy as ever. And we continue. There was a lot of pent up demand for people moving out of apartments into single family homes, people moving out of the dense urban living into the suburbs, and, you know, psychologically moving into new construction versus existing homes. New constructions just feels a little cleaner, a little safer, besides having the extra space. And with all the people working from home now, that extra space is at a premium. So what do we see for the next 6 months? You know, there is some legitimate concern that when the supplemental federal unemployment benefits of $600 per week end at the end of July going into August, there could be in parts of the country significant increases in rent delinquencies, evictions, and foreclosures. We are just not seeing that probability here in Memphis or with our properties. Of course, it's a dynamic situation. Things could change, but right now we see no reason to think that is going to change our performance with our tenants in our market. But it does bring up the point, if you do have any rental properties in markets that may be more affected by that, more affected by the $600 a week going away in unemployment, if you're in a property with an area with a higher unemployment rate, or in a different level of real estate class, or even apartments, now is a good time to kind of evaluate your options. And it may be a good time to look at a 1031 exchange into a more stable market like Memphis and more stable class like Class A single family properties. So we can always help people with that analysis if that's something you want to look at. But now I'm just going to turn it over to Kevin to shed some more light on the overall market and what we're seeing going forward overall.
Okay. Well, thanks, Kent. Yeah, so I'll try to just kind of expand a little bit and look a little bigger picture at what I see going on nationally, and you know, and how some of that seems to be translating down into Memphis. You know, as we've been seeing, real estate volume across the nation has been down significantly, but that's because there's just not a lot of inventory available for sale on the market. I've corroborated this with my colleagues in this real estate mastermind group that I belong to. You know, they're seeing the same thing. Where there's inventory, especially new construction, it sells very quickly. And as a case in point, the market in Memphis in May for us was extremely strong. We sold more to investors and retail home buyers in May than we did from January through April. So it's really, really been busy. Investor activity and our forecast remains pretty strong for June as well. So we see this continuing. Nationally, I've been reading a lot in the news, looking at the various pricing forecasts, and I kind of see a range out there. CoreLogic, for example, predicts price declines nationally of minus 1.3% over the next year. You look at the National Association of Realtors, and they think it's going to be up 1.1%. So I think one could say that nationally prices will remain kind of flat, but there will be a lot of regional variation. And where you're seeing this is in those larger, denser cities that have more exposure to hospitality, entertainment, and service industries that were affected by COVID. They're the ones that are going to be seeing the price declines in the 2 to 4% range, while the smaller, less dense cities like Memphis are expected to show modest price increases of maybe 1 to 4% is what I'm projecting. So Memphis, I think will be okay here. The low interest rates that we're seeing are also helping to drive demand for both investors and retail home buyers, and that's one of the reasons why buying activity has remained strong. Now, home prices and rents, where they are affected, are going to be more affected at the lower end of the price ranges. These would be the homes that are priced like 25% or so below the median home price of the local region. And that's because at those lower price points, they're more exposed to the COVID-affected industries, hospitality and whatnot. So I think we can expect to see over time an increase in foreclosure activity at those lower price points as the banks tighten down on mortgage forbearances and evictions are allowed again and so on. I think we are going to see some pain there. But again, it's going to be in those cities that have the most exposure to hospitality and service. As to rents, CoreLogic reports that rents over the last year rose an average of 3% nationally, as of March, year over year. And that's pretty consistent with what we've been seeing in Memphis. We've actually seen rents go up slightly more than that. But going forward, I think we can expect to see the effects of the COVID pandemic reflected in rents. Growth in rents at the low end of the market had been high the last couple of years, but that's the segment that's going to be most impacted. And here again, we're going to see a big regional variation. For example, I read in the news that CoStar predicts there will be a 10% decline in rents in the San Diego region, in apartment rents. In Memphis, though, we're just not seeing that. We're projecting rents in Memphis will remain relatively flat. And that's mainly because the price points of our rental homes are higher. We're selling brand new homes, which are the most popular of the homes to rent right now. And we just simply have fewer tenants working in the adversely affected industries. Now, shifting gears a little bit, I think variously in the past we've spoken about special work that we're doing in various regions in Memphis. And one of the areas that we're very active in right now is Byhalia, which is located in Marshall County, Mississippi, which is part of the Memphis region, a little bit to the southeast of Memphis. So we're working very hard to develop a more significant presence there. And I just want to give you a flavor of why that is. There's a major beltway around southeast Memphis called Interstate 269, which is very recently completed. And it intersects another interstate in Memphis, Interstate 22, right at Byhalia. And that's opened a very key transportation link, and it's attracted a lot of investment in that part of Marshall County. The Marshall County Development Authority has attracted numerous large warehouse and distribution centers there, especially in recent years. And these would be companies like Rockwool, Volvo, Post Cereal has opened a distribution center, Niagara Bottling, McCormick Foods, the spice company, Cooper Tires, Corel, which is they're the makers of Pyrex dishware. And most recently, we've gotten announcements from Kellogg's Cereal, Nike, and Amazon has put in a very large distribution center there. Amazon, we know, has very large plans to grow in Memphis, not just in Marshall County, but at other sites in the Memphis region. And so we're tracking them very closely to see exactly what their expansion plans consist of, because we want to stay out in front of those guys. I looked on Indeed.com. That's that big job posting site, and they're currently advertising right now over 1,200 jobs in Marshall County at a time we're seeing very high unemployment in most places. But Marshall County is expanding. So these are the reasons why we're expanding our residential development and home building there. We expect to tell you more about that as our plans firm up and we get some deals locked down that we're working on. But these are very exciting developments, and we're really trying to stay on top of it. So going forward, we're really tracking three main things, and Kent touched on a number of them. The unemployment picture, the moves by the government to support the economy, and of course the COVID health picture. So we've seen the unemployment rate, while it's still growing, that the rate of unemployment growth, or the decline in employment is starting to, that rate is declining as people are starting to go back to work in many industries. We're seeing the government still working out the particulars of getting additional economic stimulus into the economy. So Congress is working that out as we speak. And nationally, we have an unprecedented effort to accelerate the development of a vaccine, while the municipalities are closely monitoring these possible COVID spikes that could break out in certain areas as a result of people going back to work, in phases. So, we're just going to have to see how this plays out, but I'm optimistic that we'll manage our way through all of this. So we'll keep you posted on, how real estate gets affected depending on how this all plays out. So with that, I'll turn it back over to Brian.
All right, great. Thanks, Dad, and thanks, Ken, for the updates. It's reassuring that not a whole lot has changed over the past few months in a time of some pretty strong uncertainty. As far as the last thing that we're going to be sharing about today, it's something that is near and dear to my heart and something that's been a work in process for, I would say, about 3 years. And it's the Investor Portfolio Performance Report. So I want to give just a quick teaser. We're officially launching this later this month, but I wanted to take everyone on the call through what we're actually working on, so people can have a sense as to what to expect, and just get a sense of what we're doing on the back end to really give the investor an even better and more comprehensive experience. So the background on this project is, starting in 2014, we switched to a different property management software known as Appfolio, which allowed us to actually track our investors' returns. So many of you know that when we first sit down and talk about your goals and objectives, we put together what's known as a pro forma, which really is just a 10-year estimate of how we expect your home to perform over that span. Well, many of us get that 10-year pro forma, and then we wonder how we actually did. Well, this report right here is designed to show each of us how our portfolios in general are returning. I think that makes sense, our return. Anyways, you get the point. So the report itself is what you're looking at right here. And the main page I want to highlight is this performance summary. So you'll notice a few things on this. You'll notice, the purchase price, the initial investment information. And then what we're doing is we're populating this sheet with the current information based on the day that the report gets generated. In this case, it was a report from the end of last year. So we're seeing that, the property, had appreciation of about 5.3% year over year, which you can see in row F. The total appreciation can be found in row E. We're looking at the overall cash flow that this portfolio of homes has generated in row G. You're looking at the cumulative debt paydown in row J. And most importantly, I think rows L and M show the total increase in the value of investment and the compound annual growth rate of the return on investment. Compound annual growth rate is a similar term to IRR and is a proxy that makes sense to use for this particular report. So what we're endeavoring to do here is to provide all of our investors with an annual report that shows each one of us how we're performing overall. This way we can make more strategic decisions about what properties are really high performers, what ones may not be performing as well, so we can really recalibrate and modify our portfolios to be the best performing that we can in this particular market. So we're going to be releasing future videos of how to read this. We're going to go into greater detail about what each of these line items mean, but we're really committed to giving each one of you a real comprehensive sense as to how your investments are performing so that you can make the best decisions for you and your family. So we're really excited about this. It's been a long time coming and something that has been a labor of love, to put it lightly. So as these reports come out over the next several months, please be on the lookout for them. What we're going to do for this first round is we're actually going to reach out to you via email, schedule a call to walk you through it, and then we're going to have resources available to help you better understand this report. So that being said, that would be the final teaser we have for today. I just want to check in. Jordan, have you seen any questions, Roland?
No, not as of yet.
All right, well, this would be the last opportunity for folks to write in with their questions. Otherwise, we're going to go ahead and wrap up this conversation. We're going to get this video actually added to our website, so anything you missed or you wish to rewatch, you'll be able to go back and reference that here probably within the next 24 or 48 hours. So no questions have been flying in. I just want to thank all of our panelists for being here. I really want to say thank you to all the investors for your continued trust in us. We have very much enjoyed the privilege of investing, taking care of your investments and really helping you guys achieve your investment goals. And I think we actually just got one question that popped in. So Tim, how many are here? Can you confirm, are you referencing how many participants are here as far as viewers? If that's the case, last I checked, it was in the teens. I haven't checked in the past several minutes. All right, any other questions? It's funny to ask a blank screen if there's any more questions. All right, everyone. Thank you all so much for your time. That concludes it from us. Any other words from our panelists before we sign off?
No, we sure appreciate you being here. We're going through some interesting times, but we're doing our level best to stay on top of things and make sure the investments continue to perform. So thank you.
Awesome. All right, everyone. I wish you an extraordinary rest of your day. Please be safe. Please stay healthy and enjoy friends and loved ones. All right. We'll talk to you all soon.
All right.
Thanks, guys.
Bye-bye.
Goodbye.